I do like to start off every show with a summary of kind of what I saw happening with the market this week. And so it's been a pretty active week,
Hmm.
actually. Matter of fact, it's been down every day this week. It was down last Friday, too. So six
Yeah.
days in a row. It's down today. And so let me share a chart and we'll start with that. Okay. So really, obviously, this week we have a couple of main pieces that are driving the market, even before this Middle East tension really became an issue, I think last Friday was when it really seemed to kind of hit. Uh, we are already starting to see some downturn, some flattening of this big run up and what have you. So a couple of things. I always say this. I think this is really important. The market doesn't go straight up forever, and when it does go up more than normal, it generally does pull back.
Hmm.
That's kind of how it works. You can see it in the chart. You can see all the bumpiness on the way up,
Yeah.
especially, right? It's just kind of how it works. Now, sometimes, there's news we can attach to it. So we can attach the Middle East tensions and really the resurgence, or at least small resurgence of
Yeah.
inflation, right? Uh, and so, let's cover those, and then we'll talk about kind of what we see happening here. So, first of all, let's talk about the Middle East tension. And I just want to put a caveat in here because I've gotten some pushback a couple of times about this. Wars or invasions or, these geopolitical conflicts or military, conflicts I think, they supersede anything we're talking about in terms of the stock market and
Yeah.
how it's going to react and what have you. And however, the market looks at things kind of in a cold, hard way.
Yeah. It's only about the money.
Yeah, it's about the money, and obviously, war is not just about the money, although sometimes that's a factor, obviously. But the market's looking at, how is this invasion or whatever is happening going to impact the economy, right?
And then the earnings and
Yeah.
change.
Because in the end, when you look at the market long term, the market has a pretty darn good record of going up, right? You
Hmm.
look at, I think there's only one 10-year period and no 15-year periods, or maybe one where the market hasn't made money. And if you look at earnings, that's the key driver that drives these. So when you look at these conflicts, you always have to ask yourself, how will it impact earnings in the end?
Hmm.
Okay. So let's look at a couple of charts here, just some data. This one's a little bit dated, but I thought it was kind of interesting. These were a whole bunch of different geopolitical events and how the stock market reacted to that. And everything from Pearl Harbor to, the Iranian general that was killed in the airstrike back in 2020. So this is a little dated, but still kind of fascinating. What happened within one day?
Yeah.
How far down did it go? So within one day, it dropped 1.2%. The ultimate drawdown on average was 5, right? But a pretty good size range. I mean, Pearl Harbor dropped 19.8, right? So almost a bear market,
Yeah.
downturn after that. And so there's always this fear, but then, it hits its bottom on average in 22 days and then recovers within 47, right? So that's the norm. And this is kind of actually, I think, this chart, which I just pulled off of JP Morgan's site, actually an article that they wrote about, how the impact of geopolitical. This is pretty interesting. There's a whole bunch of different events there that are in that kind of gray squiggly lines,
Yeah.
and it shows 12 months before and 24 months after, right? So here's the event. So if you look at the average, the market kind of shrugs these off, right? I mean, Ukraine's an example where the market looked at Ukraine, it dropped, in terms of the returns. And then, we're not talking about Ukraine anymore. We did for quite a while, even though it's still going on.
Hmm.
And we still had this great market run and all these things that have happened, even while Ukraine has happened. So when you look at least the conflicts that we're having now, you have to look at oil,
Yep.
right? It's the one thing that can really have an impact on the economy. It can impact company earnings, and especially in an environment where we already have inflation that's above target. Yeah, because it can push the inflation up even further, which makes the Federal Reserve raise rates even more, which makes it more expensive to operate businesses, more expensive to borrow money for consumers. Consumers spend less. You end up with more recessionary chances, right? This whole kickoff. And so this again came out of the JP Morgan article. Just oil prices are still relatively low. If you look back, it went to $130 a barrel, right? Right as the Ukraine situation unfolded. And the reason that was because Russia had 11% of the world's oil production at the time.
Hmm.
And so there's a fear that if you take that oil production offline completely, you're going to end up with, very high oil prices. And I read some articles talking about $260 a barrel oil, which would have been wildly inflationary, at that time. And again, we were dealing with inflation at the beginning of 2022 as much as we are now, even more so to a certain degree. So, but what we have found with oil, interestingly enough, first of all, is a lot of that Russian oil kind of is still getting out there in different formats as far as that goes. But uh, also, the U.S. produces a lot of oil.
Hmm.
And so we were able to kind of bring some more oil onto we're net exporters now, which is not a normal scenario for my lifetime. It's kind of, a newish development. We're net exporters. We're able to bring stuff. And there's this thing called demand destruction. So when oil gets really high, people cut back. Europe cut back. They came up with all kinds of different ways to get around, the oil problems that they were having because they were getting a lot of supply from Russia. We were supposed to have a really wild winter in Europe because the Russian oil was being cut off.
Hmm.
Turned out to not be true because of cutbacks, U.S. oil, natural gas, these other things that they were able to find. And so demand destruction happens when the oil prices get too high. And when we were talking about this earlier, you made a good point that, OPEC is, trying to control the price of oil as far as what they're doing in production. But when it gets really high, some of these countries might, decide
Yeah.
to produce more at that
So
price.
if oil reaches a certain point, countries will turn on the taps.
Yeah, exactly. And then that brings down the price again. So it's something to watch. It's definitely on an uptrend right now, right? But at this current price at around $88 a barrel, that is not a problem for the economy. It's not a problem for earnings and what have you, too. So, we just had we've had back and forth between Israel and Iran, obviously, and Israel sent in, another strike. And so we'll see how Iran reacts to that and what have you, too. And these are important things. Uh, I would say the thing that hasn't happened in any of these conflicts is some kind of nuclear conflict, right? So that's always out there, and that can have some really unknown consequences in terms of the economy and earnings. So we'll see how this plays out, but hopefully things work out okay as far as that goes. But that's probably the number one reason the market's down. The last 6 days in a row is
Hmm.
just kind of this ongoing conflict. However, at the same time, we've had the Federal Reserve out in force all week long. Man, there's been Jay Powell, Williams, the president for New York, the president for Minneapolis, Bostic, the president for Atlanta, et cetera, et cetera, et cetera, have been coming out and talking about basically leaving the rates up for longer.
Hmm.
And then Williams yesterday mentioned that, hey, it's not a base case, but we could even raise rates. So that's the first time we heard that concept. Now, we've been talking about the fact that we don't think rates might not drop for the whole year.
Yeah.
And that seems to be a new development for the market and is trying to deal with that. This is a market that felt rates were going to come down, six times this year. Well, this is the core PCE price index, okay, year over year. So we compare, let's say, this March versus last March of last year. And core PCE, again, is what the Fed is looking at when they want to get to 2%. This is the chart for the last year. That doesn't look that bad.
Yeah, it's a pretty smooth descend down.
Yep. And we're at 2.78, okay? So the problem is that month over month. And so let's look at month over month. If you look at month over month, and again, a little hard to see this, but we've had a big spike here in the first quarter on a month over month basis.
Hmm.
And more importantly, we had a very low month over month basis last quarter, in the fourth quarter of last year. And so that's what caused this market. So fourth quarter of last year, the actual annualized PCE, if you just took the fourth quarter, it would have come out to be 1.5%.
Yeah.
The Fed doesn't want 1.5% either. Matter of fact, they probably are a bit more afraid of 1.5 or lower than they are of 2.78. And so they started talking, I think, very nicely, talking about rate cuts, putting rate cuts into the dot plots, never saying anything about raising rates or, any of those things. And then we get this first quarter, and all of a sudden we get a jump in, this month over month. And inflation gets a little bit hotter, and now we have the Federal Reserve coming out talking very aggressively. Maybe we'll even raise rates. And Bostic, who's actually a guy that likes to cut rates, is now down to just one rate cut at the very end of the year.
Hmm.
And so the market is kind of struggling with these two aspects. But again, if we look at a couple things, number one, look at the trend of the month over month for the past 3 years. Yeah, we're up, but this has happened all the way. Again, look at the yearly trend, right? Pretty good, even though we had this mess month over month. And so what I'm trying to point out is that it's not a straight line month over month.
Yeah.
It just isn't. And it's not a straight line quarter over quarter for that matter. So you're going to have quarters where it jumps up, and you're going to have quarters where it's lower than expected, and those types of things. And so we have to be really careful about getting wrapped up in that. And the market's definitely getting wrapped up in this. And we do, want to be careful about the overall trend. And the institutional memory that bothers the market the most is what happened in the 70s, where inflation was coming down very nicely, maybe something like this. And then all of a sudden, they started to lower rates and inflation got out of control.
Yeah.
Right. And so we're in this tipping point right now where the market's worried that, they might leave rates up too long, create a big recession, or they might lower rates and we get a resurgence of inflation. And
Yeah.
all of this is revolving around the 70s, which was a very tough time.
No one wants that death spiral, essentially.
No, and in the 70s, we had high oil prices. Oil went from $4 in the 60s and 70s, from $4 to $40 a barrel, 10 times. It'd be like going from $88 to $880. Yeah, that would be bad, believe me. The world is completely different right now. There's a lot of other resources other than oil that can be used, and there is a lot of other products like even electric vehicles and what have you that are out there. So again, you get gas prices going up, you get kind of demand destruction. So there's the conflict piece that's driving the market down. Generally speaking, that's the initial response is the same. It comes down, and then the market starts shrugging it off. We'll see if that happens this time. Here's inflation, the other big bugaboo. Again, one quarter does not destroy this whole story as far as that goes. So you got to be careful of overreacting to what's happening to the market, especially when we look at kind of the primary trend. Okay, so the yellow line is the 50-day moving average.
Mm-hmm.
The blue line is the 200-day moving average. One of the pieces for us that denotes primary trend. So its primary trend is up or down. That's a huge deal. For us, we have two different trading systems. When primary trend is up, we generally will stay in the market and just use our list and the momentum on that list. So we'll buy the things that are moving up. We'll keep our core positions and we'll just keep in there and just keep going. And sometimes the things that are moving up on our list are more conservative, dividend paying stocks, utilities, even T-bill type things. And we'll move into those if they come up to the top. And so we can get more defensive, but we don't move in and out of the market when we're at a primary uptrend. Now, primary downtrend is when we start using our signals, right? So right now we've got a signal for stock at red, yellow, and red for bond. But both of those are still in primary uptrend, so we're using the list. And what happens with the signals is when they change, we modify the list. So when it goes to yellow, we get rid of the more aggressive stuff off the list. When it goes to red, we get rid of even more aggressive stuff, and we're left with like ultra short-term bonds and T-bills. And we will make those moves because you can tell when the 2022 there, when the yellow became lower than the blue line, right?
Yep.
That's when you want to be really careful because even though there's a lot of big run-ups, the lows kept getting lower and lower and lower. And if you look now, the lows are higher and higher and higher. Okay? Very, very important to understand the primary trend and understand the primary trend and hang in there until that primary trend changes. Maybe you make some adjustments on a rotational basis, but you stay in the market. You look at that, the arrow that happened before this last one that's happening right now, that was a great time to make sure you were still in the market. Right? That was October 27th. We were doing a show. The 72-year history of the survey that the Bank of America puts out for the big money managers. They had their lowest exposure to stock market at exactly the wrong time. All right, they're not paying attention to the primary direction. Right, they're doing shorter term trading, which is really, really hard to do. And they lost out possibly in November. Right after that, the market went up 8.9%. So got to hang in there. A couple other things to consider is just the market's kind of stretched out. Right over Easton's head there, we can see this RSI indicator, okay? And we can see, kind of where it was before, but right now it's getting quite low. When it gets low, here's some arrows that show kind of points. Now, the thing about this RSI indicator, it shows decent buy points. Sometimes they're outright, reversals, like October 27th.
Yep.
A really good buy point. So this is when the market gets stretched too far to the downside, but not all of them work. I mean, one of them you can see was in the 2020 downturn. It was quite early.
Yep.
Market dropped about 20% after that. You know, quite a few of them were the beginning one in 2022 there, kind of the fourth one over from the right. Had a little jump, right? A
Yep.
couple days, and then back down. So, but I'm thinking we're getting stretched to the downside here. We're going to find some support, and I think this is my last point, and this is a really important portion. We're not going to stop this downturn until we get to support.
Hmm.
It's too much momentum. It's too strong. And so the two big support points on the S&P 500, you know, we got to 55, 5250, 5240, something like that was the all-time high there.
Yep.
But 4,800 and 4,600 in that range, there's a lot of support. We spent a lot of time over the last few years in that range. And so if we get down to 4,800, that's a 9% drop from the high. If we get down to 4,600, that's a 14% drop from the high. That seems quite reasonable, considering how much run-up we've had and how much stretch. So you combine those support points with the RSI getting down to 30, I think we get a bounce here off that 4,800.
Mm-hmm.
We could get a bounce before that and then fall back down again to 4,800, you know, because there is a big stretch going on and somebody's bound to come in and start buying here, maybe even next week. So sometimes it takes a little while for the whole thing to unwind before things kind of get going again. But there's no real reason, at least at this point, to be, you know, bailing out of the market or making any major changes. You got to kind of stay in there, hang in there, watch for these different bounce points and see what happens. And because until proven otherwise, the primary direction is still up.
Mm-hmm.
And you can't trade, in my opinion, on the secondary. There's a primary is up. The secondary is what we're dealing with right now, right? This could be the beginning of a new primary downtrend, that's for sure, but you can't tell that now.
Yeah, it's too early.
Well, yeah, if you go back, I mean, look at how many times, you know, if we go back to this one, look how many times you might have thought the primary trend was gonna, there's what, 5 there, including this one.
Mm-hmm.
Now this one might be, but the other 4 were false. You needed to stay in on all of those.
Mm-hmm.
Yeah, until you get a new lower low, a 50-day moving average below the 200-day moving average, you still have to go with it work. Now, this primary and secondary, you know, direction came from Charles Dow, right, who invented started the Dow average, right, started the Wall Street Journal, and from his writings, they developed this, you know, kind of rules for trading, and this is going back to 1880.
Mm-hmm.
It's still pretty well known. I think it's an important component as far as that goes. There's a lot of news today or this week about the market falling below the 50-day moving average, falling below that yellow line. Look how many times it's done it before, both ways. Went above, didn't matter, went below. That's not a great trading signal. Use that crossover, that's a pretty good trading signal, right? It's wrong sometimes. It's late all the time because it takes a while to develop. But you get into the meat of the move, whether it's up or down. So to me, that's why they call it the golden cross and the death cross, right? When those happen. So we had the golden cross in February of last year. Pretty darn good point to be in the market. Yeah. So anyway, that's what's happening, at least in my opinion, you know, for this week. Hang in there. This isn't a time to be panicking or what have you. Yeah, we all had higher values, you know, a few weeks ago or what have you. That's okay too. You know, if the primary direction stays intact, we'll get back to those higher values and we'll just keep on rolling. There's some things we can do to take advantage, you know, just based on, you know, what's happening with the rotation on our list, and we're doing those things now. But overall, you're going to want to hang in there on these particular market moves as far as that goes. So anyway, that's what's happening this week. Thank you for joining us. Look forward to kind of going over this again next week, and we'll see what's happening.